So let's go ahead and let's just kind of do a little bit of an equal weighting on here. 33.33%, 33.33%, 33.33%. We're not using the dividend discount model here, so what we have is a weighted average target price of What's up, everyone? My name's Robbie. This is Robbie and Mila, and today we're talking about AMD. So quick shout out. Thank you, Jin Shin. You asked me to do Visa stock, which is the last video I did, and in that same little thing you wrote to do AMD. So I decided to go ahead and do that as well. So 2 stocks from you. Thanks a lot. Let's go ahead and talk about what we're going to go over in the video. If you watched my videos before, you know that I've created a stock ranking system. I call it the Cat 5 score, or Cat 5. So Cat 5 consists of 5 different categories, and the first one is called the Rolex score. That score helps me figure out if I have trust in the company and if the company has quality. The next thing I look at is the industry-based valuation. Then I look at an industry-based profitability. Then I look at an industry-based growth. Finally, there's a liquidity score, and after I go through all of that, find the Cat 5. Then I move on to a discounted cash flow. For this company, I might do EV to EBITDA, I might do price to sales, we'll see. And then we'll go over some technicals at the end. So there's a lot to go over. Let's go ahead and get this thing started. Let's go over quickly what AMD does, just so we have a quick overview. So Advanced Micro Devices, which is AMD, operates a semiconductor company worldwide. The company operates in 2 segments, computing and graphics, and enterprise, embedded, and semi-custom. Its products include x86 microprocessors as an accelerated processing unit, chipsets, discrete and integrated graphics processing units, GPUs, data center and professional GPUs, and development services and server and embedded processors, and semi-custom system on chips, SoC products, development services and technology for game consoles, processors for desktop and notebook, personal computers under the AMD Ryzen. I do know that it's pretty popular. When I was looking at computers, Ryzen processors were definitely in there, and some of the ones I was maybe considering. So anyway, that's about the company. We won't go too far more into exactly what the company does. What I want to do is I go through a lot of the financials in these videos. So let's get started because we got a lot to go over. For AMD, the first thing I'm going to go over is the Rolex score. So what I do with this one is I use what's called the Piotroski F score. I like to see a 7 or more for the F score. The highest F score you can get is a 9. If this company has a 7 or more, it gets 5 points in my system. If it has a 5 or a 6, it gets 2 points, and if it's less than that, it's 0 points. Let's go ahead and see what the Piotroski F score is. So the F score is a 6 for this company. I like to see a 7, 8, or 9. 6, not too bad. I mean, it's okay. They got a deduction because they didn't have a higher return on assets year over year. They didn't have a higher current ratio year over year. And the big one, which is less shares outstanding year over year, which is something I definitely don't like to see. We'll see if it's justified, but it's definitely going to get a very bad, probably Rolex score in this one because it has that one as well. So coming back, we have the actual 6 was the actual Piotroski F score, and the score I give that is a 2. So 2 points for this one. Now, of course, we saw that shares are actually increasing, which increasing is 0. So they're not getting any points there because I don't like to see it when shares are increasing. But we'll see later. Maybe in the growth score, it's going to help us figure out if maybe it's okay to have increasing shares still. But anyway, we have a 2 out of 10, so that's 20%. So not the best Rolex score. Let's keep moving on here. Next thing we have is the industry-based valuation. I use Deciles to figure this out. Let me just quickly explain to you what that means. So this is just an example of all the PE ratios in the construction supply industry. So I took all the PE ratios in this industry and I just threw them in here. And as you can see, they're all over the place. They're not really sorted, but what you can do, of course, is you can see the different PEs of all the companies. Now, the next thing I do is we sort these different PEs from lowest to highest. So HYLN has a 1.53 PE, and the highest is WNC, which is 8,470. So off the bat, you could see if you took an average of all these PEs, this giant, huge PE would just throw off the whole average of all of these stocks. So what I do is, instead of you basing the score on just the average, which I was doing before, what I decided was it's much better to do deciles. So we're deciles. So if you took the first like 3 here, this is the first decile. So 1.53, 8, and 9.94. This is the first decile of PE ratios. Next is decile 2, 3, 4, 5, 6, 7, 8, 9, 10. So the most expensive are in the 10th decile, 88.63, 90.24, 8,470. So that's what I'm doing in this. I'm basically breaking it down into deciles and using that to see if a company is in a high PE ratio and I don't like it, or maybe a lower comparative PE ratio and I like it. So you can see here for my rankings of this, so PE ratio with a decile of an 8 or more, meaning it's in the expensive decile, they don't get any points. If they have a 5 to 7, they get 2 points. And if they're in the 1 to 4 decile, they get 5 points. So let's go ahead and figure out what decile the PE ratio is of AMD compared to its industry. So here we can see AMD's PE ratio is 42.64. We can go down here and we could say, okay, well, it looks like it's in the 7th decile. So that means it's going to actually get 2 points. It's not going to be too bad. It's still getting some points, but not the best. If we look at the forward PE ratio, 23.81, we can go down here. 23.81 is going to fall under the 6th decile. So that's also going to get 2 points for the forward PE, the price to sales, 10.73. That's actually going to be in the higher decile. That is in the 9th decile, so that's not going to get any points. So I'm going to go here. We have 7th decile, 6th decile, 9th decile. So PE ratio, 7th decile, forward PE, 6, and price to sales, 9th. Next we have price to free cash flow. Here we can see the deciles for price to free cash flow. AMD's 54.76. So this has about a 7 decile, so that also gets just 2 points. So 7th decile. So here we have the scores. So we're going to go with a 2, 2, 0, 2. So it looks like a pure valuation score for AMD is going to be a 30%. Moving down to the industry-based profitability, we're going to see what the gross margin and net margins look like. So let's go over there. So for gross margin for AMD, it's got a 48.20 gross margin, so pretty good. If we look down here, what is that going to be? Actually, it's going to be a little bit less competitive than I thought it was going to be. That is about a 6th decile. So it's in the 6th decile, so it's going to get 2 points on the ranking. Next, we have the profit margin, 19.20. That is going to have a bit of a more competitive profit margin, which is good. You know, we want to see profits, of course, and that is going to fall under the 3rd decile. So that's actually going to get a full score, 5 points. So 6th decile, 3rd decile, 2 points, 5 points. So the industry-based profitability is actually going to be a 70%. So better than some of the other scores. Let's see how the company does in terms of growth rate. We're going to look at revenue, earnings per share, and free cash flow. Now this is based on a 5-year compound annual growth rate. So let's go to revenue, aka sales. So sales growth over the 5 years, 30.90. So actually it's in the 1st decile. It kills it on the growth, so really good. And in terms of earnings per share growth, we've got a 44.60, which is going to be in the 1st decile as well. So really good. So a growth, in terms of growth, this company's got it. It's great. So let's go down here. We're going to say 1st decile, 1st decile. Let's take a look at free cash flow growth. Here I have some calculations for free cash flow growth. As you can see, the free cash flow per share growth back in 2018 was negative, 2019, 0.24. Growing up to 0.64, 2021, awesome, 2.67. That's actually a 3-year compound annual growth rate of 124%, which is fantastic. I want it to be more than 10%. So really good on free cash flow growth. Remember, I'm not using the decile system in this one, so free cash flow, I just want it to be more than 10%. Full scores for everything, 100% industry-based growth. Next thing we want to just see is the liquidity score, and that's the last one before we see our total Cat 5. So liquidity score, we use the debt to equity ratio. This is actually 0.09, which is really good. So I want it to be under 2, definitely under 2. So that is actually going to get a 5 as well. So liquidity score looks pretty good too. All right, so what is our final tally here? So let's go over it real quick. For the Rolex score, we had a 20%. For the peer valuation score, we had 30%. For the peer profitability score, 70%. Peer growth, 100%. Liquidity score, 100%. The total Cat 5 is 35 out of total possible of 60, which is a 58%. I like to see this at 70. Let's see. What we got here is basically this is showing us that this company is really good with growth, it's pretty good with profitability, and it's fine with liquidity. So the question is, are these three going to be okay for you to buy the stock? Well, let's take a look at the discounted cash flow. We'd usually go and look at dividends here, but there's no dividend to look at. So discounted cash flow it is. So over like 5-10 years, this company doesn't have free cash flow, but as we saw that the free cash flow is really good for the past 3 years, over 100%. I think it was 125%. So the question is, what are we going to do with the growth rate on this one? So we're going to use a discount rate of a 9. Going to give it a 9. We're going to say that the free cash flow per share is $2.62. And we're going to now figure out a growth rate. Let's say it's got 30% growth. I'm just going to go nuts here. 30% growth over the next 10 years. This company is now valued with a 44% margin of safety. The company is trading for $109. The fair value on this would be then $197. I don't love going this high on growth rates because over 10 years, that's really hard to hit a 10-year growth rate because, growth rates probably will decelerate. Let's say they do well over the next few years, but then, the following few years doesn't do so hot. So let's change this. Let's go with this. Let's say a 30% growth rate over the next, let's say, 4 years. And then over the next 16 years after that, we have just a normal rate of 4%. Then what happens? Well, now we're looking at a stock that's worth $74.84. Okay, let's change it up a bit. Let's say 5 years, this thing can grow at 30%. We're looking at 22% overvalued. So still, we're not quite getting there. Maybe we need to increase the actual growth rate, let's say 35%. Now we're getting really close here. So if 35% over the next 5 years, if this company could grow at that, it's fairly valued. Well, it did 125% with the past 3 years compounded annually. So let's say, I don't know, let's go with 40%. How's that look? Well, now AMD is actually undervalued. There's 12% margin of safety, worth $125. 109 would be what it's trading at today. So, okay, what is this to you? What do you think? I have not done enough research to find exactly what I think this growth rate should be, but I know that I don't always love going too high. Let's go with a 20. Maybe I'll even give it 20 over the next 6 years instead of 5 years. I'll at least give into that. And so in that, it's worth $69 per share. So this is the free cash flow model. But let's take a look at some other ways to kind of look at this. So one way we could look at this is a price to sales model. So here I have forecasted shares outstanding. So if we look over here, what were the shares outstanding recently? Well, the increase was over the past 3 years, about 5%. Median was about 5%. So let's say that they're growing their shares at 5%. Let's also say that the forecasted revenue growth. So what's forecasted revenue here? Let's go over here. Revenue growth was 68% 1 year, 3 year 36, 5 year 30. So I'm going to use a bit more conservative 26%. And actually, let me bump this up. So let's go with a 35% and we'll decrease it from there. 30, 25, 20, 15. So I think I'm giving it a decent growth rate here. So it's decelerating. It's starting at 35%, going down to 15% by 2026. Next question is, what's the proper price to sales ratio to use here? So here's some historic price to sales ratios. You can see 2017, 1.86, got up to 11.34 in 2020. The median is 7.63, average is 6.9. Let's give it about a 7.5. So 7.5 is going to be this one here. And we're going to go through the range. So from 2, 5, 7.5, and 11. This is going to give us a little pivot table. So in 2022, let's say we thought it was a price to sales of 2 given our forecasts. Well, this stock is worth $33.88. Price to sales ratio of 5, 84. Price to sales ratio of 7.5. Now we're talking about 127. And then 186 at 11. We can also look out into 2026. What's it worth? To $239. And then we have the compound annual growth rate given those things. So the compound annual growth rate of what we had shown before, so at 7.5% price to sales, 15.74% is expected growth given that. And I think that actually may be obtainable with this company. Going out to 2026, it would equal a 16.92% rate of return, compounded annual growth rate. So I think I'm actually okay with this. We're looking at the forecasted price to sales 2026. By 2026, it would equate to a 3 for price to sales ratio. So let's go, that's price to sales. Let's go to EBITDA, valuation, EV to EBITDA. Very similar to how we got to price to sales. We're going to do EV to EBITDA. Again, we have forecasted shares, 5%. Forecasted EBITDA. So here we got to find a growth rate. Now, we don't have a 5-year growth rate. We have an 8-year growth rate, 37%. Then we have some really high 1 and 3-year growth rates. So what do we want to use? Of course, I want to go to aggressive. So I'm going to use a 37, which is the 8-year compounded annually. And I'm going to kind of decelerate it here, 37 down to 20. So the next thing we need to do is we have this pivot table. And we have the EV to EBITDA multiple, so a 25. Now let's see what the historic EV to EBITDA multiple actually is. So if we go here, historic EV to EBITDA, 38, 2017, all the way up to the highest was 2019 with a 72. The average is 49, the median's 40. So I gave us a range here between 25 and all the way up to 65. So what are we looking at here? Well, all those inputs for growth and shares outstanding, we have this. So 2022, 109 at a 25 EV to EBITDA multiple, 35 multiple would be 152, 50, and then 65. So going up here, let's take a look at the rate of return. How does that look for us? So CAGR, if it's a 35 EV to EBITDA multiple, we've got a 39% return. If it's a 50, it's a 98% return. So this is looking pretty good. We have a 33.89% compound annual growth rate for this. So I'm going to be more conservative. I'm going to go with $152 per share, 35 times EV to EBITDA multiple. I'm also going to use a 7.5 price to sales ratio. So I'm going to go with $127 per share. And then the free cash flow based discounted cash flow. Remember, that thing wasn't so good. That was 69 price target there. So let's go ahead and let's just kind of do a little bit of an equal weighting on here, 33.33%, 33.33%, 33.33%. We're not using the dividend discount model here, so what we have is a weighted average target price of $116 per share. Remember, it's trading for about 109, so it's like a 6% rate of return. Now, you might not like this one. This is very conservative, I would say, so these are more aggressive. Do you want to be more aggressive? If so, we could reduce the weighting of this because that's definitely bringing it down. We could give this like a 25%, or let's say a 20% weighting. We'll give this a 40%, this a 40%. Now we're looking at $125 per share. So that's about a 14% rate of return if that happens by the end of the year. So better, right? So definitely a bit better of a percent rate of return. I think I'd be okay with that. So this scenario, a little bit more aggressive, probably a better price target if that happened. So let's see what the technicals look like. So here we're looking at a chart of AMD going back about to November of 2020. Down here we have some support in the 100 area. So it could potentially bounce in this area. That could definitely help out. So there's definitely some areas of support if this does break down through this. If it goes up, there's some resistance potentially at 130. Resistance at 140, resistance at 155, and then of course resistance up in the 160 area. So basically this thing could definitely go up or down. I would not try to trade this. I would kind of wait and see what happens with this, and then once it breaks down through or up through, then that's when I would make a decision what I would do. Actually, one more thing is RSI, slight decline. It's been declining a bit. It's oversold. That's a good sign. MACD, RSI, not really giving me big signs here on what's going to happen. Anyway, that's all I have for this video. Thanks for watching. If you liked it, hit that like button, subscribe, see future content like this, and please watch another one of my videos on the end screen coming up right now.